So we have completed comparative financial statement analysis. Now let us start with the liquidity ratios. Liquidity ratios, we have two topics. One is liquidity ratios and one is the ratio analysis. What is ratio analysis? Ratio analysis is the process of looking at the relationship between different numbers in the financial statements. This is what the ratio analysis is. So we have the advantages of ratio analysis and the disadvantage of ratio analysis. So what are the advantages of ratio analysis? Ratios are an effective method of analyzing the company's performance. It is an effective method by which you can analyze the performance of the company and management and other users, if they have limited knowledge of financial, they can understand the ratio. So for understanding the ratio, you don't have to be a CFA, you don't have to be a CPA, you don't have to be a professional qualification of. So if you don't have, or you if you have the limited knowledge, you can understand the ratio. And after calculating the ratios can be charted or graphed. So these are some of the advantages of ratio analysis, because because now we are going now we are moving into the direction of ratio. So that's why first of all we have to understand what is ratio analysis. So apart from this, we have certain disadvantages of ratio analysis. In ratio analysis, what we do, we use historical accounting data. So we are not using the market values. So while using the historical accounting data, it's not present, means we are in the past. So that's why this is one of the disadvantage of ratio analysis. And the another disadvantage is that it's not enough to calculate one ratio. So you have to calculate multiple ratio in order to judge the financial health of a company. A multiple ratio means not only the liquidity ratios, you have to judge the activity ratios, we have to judge the profitability ratios, we also have to judge the market ratio as well. Ratio analysis is a great way to compare business of different sizes. But when you compare the businesses of different sizes, there is a problem, because every business will use its own inventory method. The asset composition can be different. The depreciation method what they are using can be different, and the return on assets can be different. So the problem is that this can act as a disadvantage of ratio analysis. In accounting, we have many assumptions and judgments that is going to influence the ratio. So we use assumptions and judgments that your fixed asset is going to last this much of account receivable is not going to be paid. So there are certain assumptions we use and certain judgments. So that's why these assumptions and judgments will influence the ratio. So, and the last one is that we only use the numbers, so we don't have qualitative sources. So qualitative sources are not incorporated in the ratio analysis. Only the quantitative factors are included in the ratio analysis. So that's why this also acts as one of the disadvantage of ratio analysis. So the advantage of ratio analysis and disadvantage of ratio analysis is asked in the essay section of your CMA examination. So what they will say, point out two advantage of ratio analysis, two disadvantage of ratio analysis. So you can easily remember the advantage and disadvantage. So its ratio can be charted or graphed. With the limited knowledge, the management can understand. Ratios are effective method of analyzing companies performance. So disadvantage, you can remember like historical data. We have to calculate multiple ratios. If the business of different sizes, then it's a very problem. And we only look at the numbers, we don't look on the qualitative sources. And in accounting we use assumptions and judgments that is going to influence the ratio. This way you can write your essay whatever it is asked. So if advantage, you can point out 2 points, and if it is disadvantage, you can write any 2 points which you can remember. So now let us proceed towards the liquidity ratios. So what is liquidity ratios? Liquidity ratios are the ratios that measures the company's ability to pay its short-term obligation. In the short term, you are going to pay, the company is going to pay its dues or not. This means your current liabilities, they are going to pay the current liabilities within a short period of time, within 12 months, or the accounting cycle, whichever is longer. So basically it is within the 12 months you are going to pay or not. In liquidity ratios, you have to remember 5 ratios. We have current ratio, we have quick ratio, acid test ratio, we have cash ratio, we have cash flow ratio, and we have net working capital ratio. So current ratio is cash plus marketable securities plus accounts receivable plus inventory plus prepaid expense. So this is known as your current assets, and that is divided by the current liabilities to get the current ratio. Quick ratio is also known as acid test ratio. In acid test ratio, what is included? Cash, marketable securities plus accounts receivable by current liabilities, and cash plus marketable securities plus accounts receivable is your quick assets. In cash ratio, we include cash plus marketable securities by current liabilities. In cash flow ratio, we have operating cash flow by current liabilities. And the last ratio, in liquidity ratio, we have net working capital ratio. Net working capital ratio is net working capital divided by total assets. So what is net working capital? Net working capital is the difference between current assets and current liabilities. Now let us see why it is marked in green. So this is darker green because this is more conservative. So this is less conservative. Quick ratio is more conservative, and cash ratio is more conservative. Why? Because here we include inventory and prepaid expenses. Here inventory and prepaid expenses is not included. Here your accounts receivable is not included. Now let us understand the difference between current ratio and quick ratio or acid test ratio. So the difference between current assets and quick assets is what? Your inventory and prepaid expenses. So in current assets, inventory and prepaid expenses are added, and quick assets, the inventory and prepaid expenses not there. So when you deduct from the current assets the inventory and prepaid expenses, you are going to get the quick assets. And in the quick assets, if you add inventory and prepaid expenses, you are going to get your current assets. And in cash ratio, we don't include accounts or receivable. So this how, and cash ratio, quick ratio, current ratio, quick ratio, acid test ratio, cash ratio, and cash flow ratio, the denominator is current liabilities. For cash flow, we have current liabilities. Cash flow ratio, we have current liabilities. Cash ratio also we have current liabilities. Quick ratio, acid test ratio also we have current liabilities, and current ratio is we have current liabilities. So the numerator only differs. In the current ratio, inventory and prepaid expenses is included. In quick ratio, acid test ratio, inventory and prepaid expenses is not included, that is not there. And in cash ratio, we don't include the accounts receivable. Now let us understand the effect on the ratio, current ratio and quick ratio. So if the ratio is greater than 1, the greater than 1 means if current assets by current liabilities, and that is current ratio, that is greater than 1. So if it is greater than 1, what is going to happen if the ratio is greater than 1? So equal increase in both the numerator and the denominator will decrease the ratio. So if the current asset is increased plus 5,000, and if the current liabilities increase by 5,000, the ratio is going to decrease. Okay, the ratio is going to decrease, and an equal decrease in both the numerator and the denominator. If for example there is 5,000 decrease and 5,000 decrease in the numerator, the ratio is going to increase. And if the ratio is less than 1, if the ratio is less than 1, it will move in the same direction. This means the equal increase in both the numerator and the denominator will increase the ratio. So if there is an equal increase in the numerator and the denominator, that is if it is 2000 in the numerator and 2000 in the denominator, that is going to increase the ratio if the ratio is less than 1 in the same direction, if it is more than 1 in the opposite direction. So an equal decrease, if there is a decrease of 3000, and if it's decrease of 3000 in the numerator and denominator, the ratio is going to decrease. So the equal decrease in both the numerator and the denominator will decrease the ratio. So let us understand now, let us understand the liquidity ratio with the help of an example. So here we have the balance sheet. Asset is given, we have liabilities, and we have shareholders equity is given. Okay, now let us calculate the current ratio, quick or acid test ratio, cash ratio, net working capital, working capital ratio. So in 2022, if we need to calculate the current ratio, so you know that the current ratio is current assets by current liabilities. So the total current assets is 26,600 by 6,800. So it comes to 3.91. So it comes to 3.91. So what is 3.91? 3.91 means that your total current liability is 6,800, but your total asset is 26,600. So you can pay 6,800 3 to 4 times. You can pay 6,000. You can pay your current liabilities 4 times. Now in 2021, what happens? No, the ratio decreases. The ratio is the ratio is the ratio is what is the ratio? The ratio is 0.31. 0.31 means your total current assets, you know, the ratio is 2400, right? 2021. Okay, 2021, it's 2400 by total current liabilities 7,800. So your total current asset is 2,400, but your total current liability is 7,800. This means you are not going to pay your current liability. So it is 0.30. So 0.31 of your current liabilities you can pay, but you are not going to pay 7,800. In 2022, the ratio improves to 1. 1 means what happens, if the ratio is 1, this means your total current assets is equal to your total current liabilities. Over here the total current asset is 8,300 and your total current liabilities is 8,300. Now in 2023 we have 3.65. 3.65 means your total current liabilities is 8,900 and your total current is 32,500. This means how many times you can pay your current liabilities? That is 3.65. So this is same for 2024. In acid test ratio, what we do? We exclude we exclude the prepaid expenses and inventory, but your total current liabilities remains the same. So we are judging by removing the prepaid expenses and inventory, whether by using your cash and marketable securities and account receivable you are able to pay your current liabilities or not. If it is the ratio is 2, this means you can pay twice. Here it's 0.71. 0.71 means you are not going to pay your current liabilities. Let us see, current liability is 7,800, but your quick asset ratio is not 7,800, it is less than 7,800. This means by using cash, marketable securities and accounts receivable, you are not going to pay your current liabilities. You are in trouble. So the same way we can do for 2022. 2022 you have total current liabilities 8,300 and your 4,000. So 4,000, 8,300. This means you need some more money. So in 2022 the ratio is good, and 2024 the ratio is good. Cash ratio, you know that we only take cash and marketable securities, and by the current liabilities. So here also we have a problem. In 2021 you can't pay using the cash and marketable securities your current liabilities. In 2022 also you can't pay, but in 2020 it's the same. Means cash and marketable securities and your current liabilities is the same. 0.119 means in 2024 we have 31,000, 31,500, but cash ratio only includes 9. See, it's what, it's 0.99 means what, only $100 remaining. Means $100 you can't pay $100 by using your cash ratio. Cash ratio means it's 0.99, means only $100 is remaining in your current liabilities, and cash and marketable securities 6 is 9, only $100 you can't pay. So this is how your ratio is, and you can understand it. So what is net working capital? Net working capital is the difference between current assets and current liabilities. So here by paying 6,800, what is remaining with you? The remaining is 19,800. So total current assets is, you have your total current assets 19,800 by paying 6,800. Here why it is minus? Because the current liabilities is high and your total current assets is you don't have total currents. This means you need 5,400. If you means you have to get 5,400 from somebody else to pay. Here in net working capital you don't have to do anything, because your total current assets and total current liabilities is the same. In 2023 the condition is okay for the company, because after deducting your current liabilities, which is 8,900, you are left with 23,600. And in 2024 by paying 9,100 you are left with 31,500. So working capital, now the last ratio is working capital ratio, and the working capital ratio is net working capital by the total assets. So when you divide by the total assets you get net working capital. This is what the liquidity ratio is all about. So let us mark as complete the liquidity ratios. So we have completed the liquidity ratios. Let us mark it complete. Now it's 13%. Let us see by completing this what percentage do we reach. So it's now we have completed 15% of your P2. Now let us return to the dashboard. Yeah, it's 15%.